Let's look at the inner workings of a nationwide universal life policy with a long-term care rider. All right, I know that's a lot to chomp on, but I get a question a lot about what I think about these policies. And Nationwide has sent me one. I guess I'm on their email list somehow. Don't know how or why, but if they're going to send it to me, I'm going to report on it so you can understand how these work. So let me always start. I have life insurance term, but I also have long-term care insurance. So I separate the two. I have long-term care through the Knights of Columbus, and I have life insurance through, I can't remember anymore, Prudential, I think. I got a good policy through Prudential Health. I have to do a video on that. I just forgot who I have it with. It was actually a very pleasant process. So I keep long-term care. So I do believe in it. I do. I will drop it once my youngest is out of the house. All right, let's just put it that way. I will drop it then, because it's getting more and more expensive each and every year. And the likelihood of needing long-term care is not very high. It just is not very high for sure. I don't want to get too deep in that here today. I've done so many books on, so many studies on that. I don't have my book here. But I talk about in my Social Security book. You can retire on Social Security. Not very likely that you're going to spend a significant amount of money in a long-term care facility. It's just not. Doesn't mean you won't, but it doesn't. Not very likely. So for me, we bought it when I was 39, I think. So I'm 49. I have had it for 10 years. Simply because it's catastrophic. If I were to go into a facility or needed assisted living or just even in-home health care, my wife would be dead to rights financially. And so that's what you do for insurance. You buy it to cover the catastrophic issues that could come up where you can't self-insure. Once Liam is out of the house, it's just Charlotte and me, we downsize and have no mortgage, we'll self-insure, but we can't do that now. But anyway, so I do have long-term care. I have a strict long-term care policy. It's not a life insurance, but I do like the ones that I find them interesting. Life insurance policies with a long-term care rider. I used to sell some of these back in the old days, mid-2000s. Lincoln had a money guard policy, which I still love to this day. I don't sell it anymore because I'm not licensed in insurance. But I would. I think it's a good product. I'm not recommending you, but this is going to be a similar one. You put a certain amount of money in, you have if you don't ever use long-term care and you die, your heirs will get a death benefit of life insurance. B, if you don't ever use the long-term care and you want your money back, you get your money back, refundable. Now, you don't make any money. That's an opportunity cost. You're not getting growth. But C, if you do need a long-term care, you get a nice amount of money to cover your long-term care. That's a fact. It's not going to give you nearly as much benefits as a pure long-term care policy, but if you're not likely to use a long-term care policy anyway, and you're not likely to spend a lot of money in assisted living, in-home health care, or nursing home, that might not be a bad way to go. But nothing comes for free. There's no insurance that you can get for free. So let's dive into this, and I'll share with you my thoughts on the nationwide long-term care policy. Again, they just sent this to me. Comparison highlights. So we're going to use it. Again, I'm not licensed. You'll have to talk about yourself to your own licensed advisor. I think it'd be worth looking into a single pay long-term care policy with a universal life with a long-term care rider. So product type, fixed premium, universal life insurance with a long-term care rider or coverage. And when I say rider, I mean R-I-D-E-R, like Rider University. Target market is 40 to 65, and this is the issue for the green one here. I guess we'll talk about this. Nationwide Care Matters 2. I'm not sure that I literally don't know anything about these policies other than what I'm going to read you here. But you can see the target market has gone down a little bit. It just gets awfully expensive once you get in your 60s for this kind of stuff. Any kind of insurance does, universal or life insurance or long-term care. Remember, there's two competing entities here. Life insurance, the insurer wants you to live as long as possible. That means they get more premiums and less likelihood to pay out. The longer you live, the less likely you're going to continue to make their premium. And even if you do die while you're still making a premium, they have more of your money that they can invest and hopefully earn a rate of return for longer while you're still living. Long-term care, they want you to die earlier. That's all there is to it. The longer you are alive in long-term care, the more risk there is to them. That's just a fact. So life insurance is like a seesaw. Life insurance, they want you to live. Long-term care, they want you to die. It's literally that simple. So when you're combining the two, inherently you have two competing things meeting together, which always makes it a little bit less efficient. But what I like about pay one time, I've always liked a single pay. So I'll give you an example. This is from 2005, I think. 2005. Husband, wife, we did 50,000 one-time pay for each. 50,000 bucks. They had a $166,000 long-term care benefit is what it was. So husband put in 50,000 bucks. He had $166,000 as a long-term care benefit should he need it. I got 233,000 on my head for a death benefit. If he did not use the long-term care, he would leave 230,000 to his wife tax-free. And he always had access to his 50,000 bucks if he ever wanted to cancel the policy. He would never, I think in the first year there's a surrender charge, but maybe I can't remember. But I mean, but if he, I think after 5 years, maybe he could have access to everything and just cancel the policy. So basically, he got his money back with an opportunity cost of not having that money invested. But he put 50,000 in, he got 133,000 or something like that, or 166,000 of long-term care benefit and a $233,000 of death benefit. All he had to do was stroke a check for the 50,000 bucks. And I thought it was pretty good. I liked that. So at the end of the day, he knew he had that side coverage, and all he had to do is take the $50,000 and turn it over to the insurance company. Same with his wife. I think his wife got a little bit more for life insurance and a little bit less for long-term care. I can't remember specifically, but they were very happy with it. I was very happy with it. I got paid a pretty fat commission, not going to lie to you, but it was good. It was a good policy, and they were happy, and I was happy. I liked it quite a bit. They had to go through underwriting, and we had a little bit issue with the husband, but we did get him through, and that's why he didn't get as much benefit as his wife did. I can't remember. We're talking 15, 16 years ago now. But anyway, so you can pay one time a single pay, which is nice, just get it done, and that's the best way to do it, in my opinion. You can pay annually for 5 years, a 5 pay. You can pay annually for 10 years, a 10 pay. You can pay annually up to age 65, and you can pay annually up to age 100. So whatever your cash flow likes. The more you pay up front, the more benefit you're going to get in the back. That's a fact, because the less you pay up front, the more that there's risk to the insurance company. So they're gonna give you a reduced benefit. So just keep that in mind. Looks like Pablo's gonna start barking. Okay, it's okay. All right, so here's the benefit period, issue ages. So you can see you have to look at the issue. A refund of premium option, inflation option. I like this actually. So here you got a refund of premium option, which is kind of what I talked about. The 50,000 you put in, the 50,000 you get back whenever you want. And again, I don't know these policies. I'm not licensed to sell nationwide. I'm just reading what they sent to me. So you can look at it for yourself and call them if you want and decide if this is something you want to do. General rule be okay. The maximum allowable premium payment option, refund of inflation, and then you can pay more to get it adjusted each and every year with inflation. That's going to be expensive. Just be advised. That's what I have with my Knights of Columbus as a GPO, guaranteed payment option, where you can increase your benefit to cover the rate of inflation if you want. You don't have to, which I actually like, because it puts you in charge of the premium increases. I think I've done that, like, of the 10 years I've had those policies, I think we've done it 2 or 3 times. $60,000 is this minimum specified amount. 500,000 is a max, and I don't know what that max is. Is that the long-term care coverage, or is that the death benefit? I don't know. Companies nationwide. Age calculation, age of last birthday. So that's pretty good. So they're just saying we're not going to, like I'm 49 now, which is actually probably a primo time to look at this before you hit 50, before you hit 60, in the age range of 50 and such and such. Here's the services covered. Once the insured by the policy qualifies for benefits and satisfies the elimination period, the long-term care benefits will cover some of the costs of qualified care. In-home health care, which is great. Includes adult daycare, home health care to assist with activities of daily living, ADLs. You need to qualify. You can't do 2 of the 6 ADLs, activities of daily living. Transferring, bathing, I can't remember the 4. But transfer is a big one. Literally getting up and rotating is hard if you got bad knees. Transfer is a big one. So in-home health care, assisted living facility, qualified long-term care facilities, nursing home care, adult daycare, and any state qualified long-term care service. That's fantastic. As long as you qualify, when I think we'll talk about elimination period, is a 90-day elimination period, which is essentially what Medicare will cover for the first 90 days if you go to a facility. No long-term care benefits are payable during the elimination period. However, long-term care benefits will be paid retroactively once the elimination period is satisfied. Benefits for the first 90 days will be paid along with the benefits for the 4 month. Okay, so I don't know how that works. That can't be cheap, right? I don't know the cost, but that's interesting. They do not pay benefits for qualified long-term care that result from attempted suicide or self-inflicted injury. Committing or attempted to commit a felony if you're an alcoholic or drug addiction, unless addiction results from administration of drugs or treatment prescribed by a physician. So you definitely want to make sure you get that looked at, if you have some kind of opioid addiction because you had surgery and you're suffering from pain, chronic pain. And I don't like this: war or any act of war, whether declared or undeclared. So if I was to be sent to freaking Iraq, they don't cover that. I don't like that. But hopefully that doesn't happen to you anyway. If you're this old, you're probably not going to war. Hopefully. So they have a current monthly administrative charge of nothing, but is guaranteed to be no more than $20 a month. Per thousand of specified amount charged, the per thousand charge applies. The initial specified amount is deducted monthly. If the specified amount is reduced due to partial surrenders during the charge period, then the charge continues to be calculated based on initial. And I don't like that, but I mean, that's part of the insurance. They got to protect themselves. You don't have to buy it. That's a wonderful thing in insurance. It's a unilateral contract. That means they are obligated to you, but you are not obligated to them, which is why you got to read the policy on the front end to make sure it looks good for you. If it's not, then don't buy it. But they're saying, hey, we're going to charge you per thousand of specified amount. And the specified amount is your initial amount. And if you reduce it because of partial surrender, we're still going to charge you per thousand based on the initial specified amount. That might seem back-ended, but you just got to read it. And I know you say, I don't like that. You can shop around. Premium expenses, that's like I hate to say a commission, but it's a load. They currently charge 5% of each premium. It's guaranteed to be no more than 5%. But they have a current and guaranteed varies by refund of premium option elected. One-time step up is 10% of premium is a premium expense charge. So that just shows you right there that they're that just shows you the higher the vested. I don't know what the vested means, but no refund of premium. 25% of each premium. I don't get all that. So anyway, just they're charging a pretty significant front-end load for each premium payment you make, which I mean, now you know. The cost of insurance is another expense, COI. The base life insurance policy has a cost of insurance rate which applies to each $1,000 of the net amount at risk and is deducted monthly. Net amount at risk is what the insurance company is obligated to pay you. So this is the difference between term and universal or whole life. Universal and whole life are two different things, but term is you're renting it, is 100% net amount at risk to the insurance company. They don't think they have much at risk, so if you're a 49-year-old guy, you're not likely to die. However, as you get older, the net amount at risk increases till when your term is 65 years old and up, that premium is going to go through the roof because a huge net amount at risk at that point to the insurance company. It's going to be prohibitively expensive. So with universal life, for instance, what happens is, in theory, in any kind of whole life, permanent life insurance, cash value life insurance, the net amount at risk is reduced as you age because you're getting more and more cash value in there. Thus, the cost of insurance is dropping or at least leveling off because your cash value is money that's your money. That means it's less money to the insurance. It's like a seesaw. Right now on the front end, because you haven't paid much into it, it's a huge amount of net amount at risk. But you're young and healthy, so it's really not true much net amount at risk to insurance company. As you get older, though, the net amount at risk reduces because you have more death benefit. You have more cash in there, but you're getting older, so it's more likely you to die. So the net amount at risk is reducing from the cash value, but still not reducing to the extent of 1-for-1 because you're getting older, which means you're closer to death. I hope that makes sense. A lot going on there. But the COI is important, cost of insurance. They don't charge a separate monthly charge for each rider, so that's good because I already talking about the charges here, premium expense charge. Residual death benefit, on the top of my head, I can't remember what that means. I just remember they have to have a death benefit or else it cannot qualify as a life insurance contract. And so they're saying 20% of the residual death benefit. Off the top of my head, I can't remember exactly if that's off the cash value. I just don't remember. So you'd have to look into that. Guaranteed return of premium, a guaranteed refund of premium on surrender. Let's see, right here, here's your vested amount. So if you have a single pay, so they're just showing you here, after year 6 on a single or 5-year pay, you get 100% of your premiums back. After age 65, by the time you're paid for 11 years, you get 100% of your premiums back. So basically, you don't get all your premiums back up front for the first 5 years. Single pay or 5-year pay, you get all of your money back after year 5, which is good. And then by year 11, you'll get all your money back, paid at age 65 or paid at 10 pay. So there you go. The refund of premium value is equivalent to all premium paid minus any withdrawals multiplied by the applicable percentage. Starting day 1, 80% of the refund of premium is available. Starting on day 11, 100% of the refund of premium is available. All right, that just, all right, I don't refund a premium. So it sounds like they're saying, look, we are not going to give you your entire refund of premium until year 11. Yes, okay. So as you can see here. All right, but if you have a single pay, you'll get it back in 5 years. Let's see, total benefit duration. So here you got the acceleration extension. So you can have a 2-year, 3-year, 4-year, 5-year, 6-year, 7-year. The longer you have, the more expensive it's going to be. I mean, this is what they're saying. Look, we're going to give you 5 years of long-term care coverage. We're going to be on the hook for 5 years. So generally speaking, the shorter you have, I think I have for 3, maybe 2 or 3, I can't remember. But the shorter you have, the less the insurance company's on the hook. I'm not going to argue for any of these things right now. I just remember the likelihood of you needing long-term care for 5, 6, 7 years is not very high. It's just not. The vast majority of anyone who's in a long-term care facility needs it for less than 2 years, but there's always an outlier. There's always an outlier, that's for sure. So if you think you could be those outliers, you probably want to extend it. If you're not all that worried, you probably want a shorter end. Just remember, the longer you have coverage, the more expensive it's going to be. The rider has his own premium amount for long-term, I don't know, the acceleration benefit, inflation protection. We talked, 3% compounding interest, 3% simple interest, 5% compounding. So they're just going to say, look, do you want to pay more for more of a benefit? And you'll say yes, and it's going to increase your premium for sure. Well, anyway, there's a lot going on there. International benefits, you can see that. You have to look into this, but anyway, I'm a fan. Here's surrender charges. Okay, so what they talk about is surrender charge associated with total premiums paid. Depends on what type of policy you have. 8, 7.5, 7, 6.5, 6, and you can see how that works relative to what we talked about before. After 5 years, you get 100% of your premium back. The maximum transaction fee is $25 per partial surrender. 1035 flexibility, tax-free transfer to another policy. So anyway, there you go. There's something to look at. Look, if you have the cash on the side, I've always found the most simple thing is just to dump the money in and be done with it, to be perfectly honest with you. Usually it's the cheapest way to go, but if you can't afford it on a $50,000 payout or whatever it is, you might want to do a 5 pay. You pay over 5 years, or a 10 pay over 10. But if you need the coverage, I think this is not a bad way to go. Long-term care policy is a naked policy just by itself. While the most efficient, is the most expensive because the insurance companies simply don't know how to price these. They don't. And it's like homeowners insurance. If your house never burns down, you don't exercise the insurance, which is a good thing, but it's not cheap. Long-term care is not cheap insurance, not to use. So that's one of the benefits of using a cash value life insurance policy with a long-term care rider. Hope this helps. If you have any questions or comments, put them in the notes. Thanks now.